Welcome to another edition of ETF Central, where we unpack the stories, the data, and the science behind what's going on in the global investment market around ETFs. I'm your host, Bilal Little, and I'm really excited about our next guest. His name is Eric Fine, Global Head of Emerging Market Debt at VanEck. What's really exciting about this particular conversation is it's one of the most complex parts of the fixed income market, and I'm really excited because he's going to unpack some of that complexity and simplify the message and maybe demystify what's going on in emerging market debt. Welcome, Eric.
Thank you, Bilal.
I'm glad you were able to make it down.
It was great being here. My first job on Wall Street was right around here, a couple blocks away.
Really? When was the last time you were here at the exchange?
For my boot camp. I do a summer finance boot camp, 6th year, and this year NYSE gave us a ring belling tour. So it was very exciting. It was my first time. I've been on Wall Street for over 30 years. I'd never been inside NYSE till last year. And thank you, NYSE.
What was that like for you? What was that feeling like?
It was really exciting seeing actual companies and their, the little lucite's that you have of them, and the issuance, just the company creation. Because what I do, I'm behind a desk and screens pretty much for 30 years and meeting government officials and, clients. And so to see actual stocks and companies get created was very, very cool. I took a lot of pictures, sent them to my family.
It's always exciting still to come to this building, even for me, right? I mean, you're talking about capital formation at its highest level. So it's always exciting. So I'm glad you enjoyed it.
Any country in the world would do anything for this. We take it for granted.
Absolutely. Eric, so it's important for me to get a good sense of who you are and to make sure that the audience understands who you are. You have a phenomenal background. I actually enjoyed reading about you. You have a background from policy to now running emerging market debt. Give a sense of what that journey was like for you and sort of how you became head of emerging market debt over at VanEck.
Yeah, I was had an unusual background, I guess, for an American. I was born overseas, grew up in Switzerland, Thailand. My dad was a spy during World War II, both for Depression, grew up in the Depression, and a lot of things happened. My dad was born 1914, my mom 27. As I said, my dad was a spy and then a career diplomat and economist. And he was MacArthur's economist for the 8 years of the U.S. occupation of Japan. My grandfather, on my mom's dad, like I also, as with my dad, Depression era, and worked in a bar, and he had a fishing buddy named Harry Truman, and so my mom was Harry's President Truman's secretary as vice president for about 6 months. She got the call from Eleanor Roosevelt when FDR died, and patched it through to what she calls Harry, and then she was a career diplomat. So that's grew up overseas, and that was my mindset. And my dad was a PhD economist. And out of the personal stuff I got out of that was when I came to America, I looked at America and every country with really a great more a distance than anyone who was here.
More objectively, yeah.
Well, objective is one word. That's, I think fair. But, for my friends, my new American friends, because, I'd grown up in different kind of places, my reactions to things were very unique and different. But what I learned is I loved looking at countries. Now, the other thing is I want to eat, and I had 2 Depression-era parents, and working and having a living was like my main job in life, and but I did like politics. Was very active in politics earlier in my life, and but one thing about politics that I realized is everyone thinks they're right forever, regardless of outcomes. And that's very frustrating if you're kind of serious or academic. And so, but in emerging markets, so I worked for the U.S. government in Russia. So I did my education, worked for the U.S. government in Russia. The Soviet Union fell apart. And a group called Harvard Institute for International Development says, we can do some stuff for the U.S. government. And the U.S. said, okay. And the U.S., this was a weird time. We were more or less colonizing Russia. This was a very unique period in history.
What year are we talking?
Early 90s.
Okay.
So Yeltsin was the president. The key prime minister at the pinnacle of this influence, I would argue, would be Yegor Gaidar.
Okay.
Right? Big reformer doing all sorts of great things that the Wall Street Journal praised, flat taxes, floating the exchange rate, independent central bank, really, really basic stuff. Or they were trying to do that. It eventually happened decades later, but this is 90s. One of the things that the Russian government and the U.S. agreed with on was voucher-based privatization. All these companies were state-owned, so you needed an NYSE. Well, they don't have one. So how do you do it? Well, we built a system. So 33 cities, 13 time zones. We built it in about 3 years. It was the first securities clearing system in Russia, and it's still there. I don't know if the exact tech, but this is hardware, so you just stuck software like Swift, like the Swift messaging system. You put that stuff on the physical system, but wanted to get into markets, right? I wanted it, because the policy and politics thing was really interesting. It's really important, but no one was ever right or wrong. And I don't know what a field like that is. And
do you recall that exact moment that you were like, okay, I need to be on that side of the house?
It was in school, in graduate school. And the school didn't like it. They didn't like people like me going into the private sector, right? But it was always my parents' advice and other folks of that generation. I got a lot of friends who were kind of come from that world, and almost all of them said, the business has changed, right? In their days, you got ahead by winning. Now you kind of get ahead by doing different things, getting a bigger budget, right? It's a lot more. Everything is a critical objective. So kind of everything, nothing really is, right? And during wartime, and it's a very, very different culture. And also, they made the point that the private sector will give you a lot more. So if you want to go into the public sector, you'll be a lot more valuable. So
Great point. Great point.
But yeah, so I wanted to maintain. I wanted to find a place where I could maintain thinking about politics and policy and political outcomes, and emerging markets is perfect for that because everything starts with policy and politics. So you get the politics, and then you get the policy outcomes, and you get the economic outcomes, and then you get the asset price outcomes. And as a sell-side economist, which I was for 10 years at Morgan Stanley, then I ran prop trading there. That's your entire job is here's the policy, here's the economic outcomes, here's the asset price outcomes, and you're right or wrong. And you put a time on it. Started in research at Morgan Stanley 10 years and always knew I wanted to pull triggers, but I thought, and I think it was correct, that I really needed to learn it from a research standpoint. And been at VanEck for 16 years and manage a variety of strategies. And it's more or less, it's completely the same thing, doing the same type of analysis, just the world changes, the country changes all the time.
So unpack your current role as head of emerging market debt at VanEck.
Yeah, so I'm responsible for managing the actively managed EM bond funds. We obviously interact with large parts of the firm, and it's a great place where idea generation is very much valued. We have a variety of strategies. We launched an ETF in Australia, exact same version of the strategy with, obviously, it's in Aussie dollar for the Aussie market, so it has different conventions. We have a variety of SMAs. And we have an actively managed UCIT in Europe. Also, a number of investors have reached out to us, and they've asked us to start specialized versions of the fund. And so we have a few SMAs. So we manage those, and that's what I do.
Love it. For those who are less familiar with VanEck, who would you say VanEck is?
It's a great and interesting company that goes where the puck is going. That if there would be one sentence for that. So in 1955, it started the world's first the United States' first international mutual fund. Remember, Templeton's a Canadian company. So it was a emerging markets equity fund, you could argue. It focused on European companies after World War II. This was managed by our CEO's father, John VanEck, and who, as Jan likes to joke, what do you do if you're really busy at work and you have a growing family? You go and try to get a PhD in economics, which he did under von Mises at NYU.
Wow.
And that's when the light bulb went off on gold miners,
Okay.
which is another big phase of VanEck's development.
Absolutely.
And then Jan comes profoundly into the story because ETFs became a thing.
Mm-hmm.
And VanEck had the best actively managed gold fund. So the question is, do we do a passive ETF that competes with this great thing that we have? And Jan's answer was yes.
Yeah.
And the rest is history. It's the biggest gold mining company in the world. And this extends to the current day with crypto and EM debt and a number of other ventures. Jan is always moving and always on cutting edge.
Oh, look, I think that's fantastic, right? Like, your firm should always be innovating to a certain extent, and if they've built their pedigree off of innovation as far as undiscovered markets, it makes sense, right? So the ETF wrapper is just an extension of that. So before we dive into some of that stuff, I do want to sort of take a step back and get your broader perspective on fiscal policy and the way investors should even consider and look at emerging market debt. I believe it's an area that presents a lot of opportunities, but for most people, it's still nascent and a little complex in their views. So how would you simplify the message given the fiscal backdrop and the opportunity set?
Yeah, Bilal, that's a great setup. I think you kind of gave the answer. I would set it up as a fiscal issue. What do you read about in the newspaper every day? Debt is too high and the interest rate is too low because the central bank has too many targets.
Yeah.
Every day, right? For not months, maybe arguably a couple of years.
Yeah.
Arguably since the GFC.
Absolutely.
Right? So that is called fiscal dominance. Economics has an answer for this. When government debt is so high that the central bank either formally or practically loses its ability to solely focus on inflation, right? Because they will bankrupt the government, and financial stability and common sense are obvious constraints.
Yeah.
That's called fiscal dominance. And that's the way to understand the world. Now, what happens if you have a high debt level and a central bank that's not maintaining high real rates to prevent inflation? Well, you're going to get higher inflation in that country. Well, has that happened? Yeah. U.S. is risking a stagflation scenario. Now, that all sounds really, really bad. There's no winner so far in the story if you're a dollar-based investor.
For sure.
Well, but let's look at the other side of it. Are there countries with good fiscal policy whose central banks have always maintained high real rates? Yeah. They're called EMs, mostly the Asians. They're the best of the best. But a number of the Latins and a number of the Central Europeans, most of the Central Europeans to one extent or another, have. And so in a world worried about high levels of debt and a central bank that really can't focus solely on inflation, where most investor money is, there are countries that have low levels of debt and central banks with high real rates, so therefore low inflation.
Yeah.
And now, if you look in particular at China, China has arguably deflation, right? But certainly disinflation. Much lower than the U.S. Well, what does economics tell you when two trading partners, when one country, the U.S., has higher inflation than the trading partner country? Well, that currency, the U.S. currency, should weaken by the inflation differential.
Fair.
And the Bank for International Settlements measures this through their real effective exchange rate. And it says the Chinese yuan is 30% undervalued. Undervalued. So that's also where the rubber hits the road. So conceptually, debt matters because central banks matter for the money.
Yeah.
And that's why the biggest, and this is arguably the biggest thing happening, because if you let's go back to the beginning of this year, 2025. What were all the cool kids saying? Trump tariffs version 2 means EM is destroyed. Their
Bad.
EMFXs have to go weaken in order to keep exports stimulated. What happened? The exact opposite. And the market is still struggling for an answer to that question. The answer is fairly straightforward. These countries are in good shape, largely speaking. You had Malaysian ringgit rallying 7% in one day. You have Hong Kong dollar pricing in appreciation, even though it's a peg, mainly because so much money was reshoring. What was up with that? What happened? What happened is, I think, fairly straightforward. These countries have been for 30 years accumulating massive surpluses in dollars. They're up to their necks in dollars. That's the starting point. Now you have tariffs. In the tariff discussion, do you think these countries, do you think there's a currency chapter of the discussion? Yes. Do you think it's going to be emailed as a press release? No. The gist of it is going to be something along the lines of, I hope you know when we walk out this room, you're not going to devalue your currency 20%, right? Okay. So pretend I'm an Asian reserve manager. I'm up to my necks in dollars, and I know from my meeting that the dollar is going to go down. What do? You reduce your dollar exposure. Now, you don't sell your securities themselves immediately. That takes longer, like your actual stocks and bonds. But Deutsche Bank had a great report talking about the FX hedging that reserve managers have been doing. Bottom line is EM local currency bonds are up 15% this year, and CNY has been stronger than the economist's prediction almost every week since November of last year. So that's why it matters, is it's thematic. You can see it in the newspaper, and it has real implications, which is central banks are not just buying gold because of this phenomena. They're buying other reserve currencies that deserve to share that status with treasuries.
That's a very fantastic breakdown and point, because you talk about opportunity. And I think most investors are looking for opportunities. And when they lean into attractive money managers, the goal is to identify the ones that can actually do that effectively. What have been your biggest surprises to start 2025 as we're coming to a close? And possibly some of your disappointments along the EM spectrum, EM debt spectrum?
Yeah, the biggest surprise is how most of the cool kids still aren't accepting what's going on. There is huge denial. It was in April of this year. We go to IMF meetings. I've been going for 30 years. And our biggest takeaway in our IMF takeaways for the spring meeting that ended in April was it is no longer taboo to talk about dollar and treasury status, reserve status.
Absolutely.
We've been talking about it, couching it carefully, and we have a view, which is the dollar's not losing its status, but it will share it with other deserving currencies. That's the right framing. And at that IMF meeting, I made a bet with a friend of mine and the market was so negative on CNY at the time, and bet I meant a gentleman's bet. I'm not breaking the law bet, but I'll buy you a beer kind of bet. And the bearishness, namely the consensus view, was so much that CNY had to weaken. I was given even odds if CNY was below 8. It's like, I don't know, 7. It's low 7s right now. And to this day, I've offered to buy the debt back, meaning we'll let him buy it back for 9/10 of a beer, and or 9.9 of a beer, and there's refusal. So the surprise is this reluctance to see CNY as a future reserve currency. That's a big shock. My biggest disappointment is Argentina, not in us. We didn't own it. There was too much joy on it. The politics were way ahead. They needed to have floated the currency at the beginning, right after they got elected, and they didn't. And what's frustrating is everyone in government knew this and still just walked right into this blender. And it's really frustrating when you've seen a movie a bunch of times, watching, smart folks that are doing a lot of good things walk right into a blender. Now, we like Argentina now because the price went down a lot. And it's a lot less, it's a much more confusing trade now. So a lot of the popularity went out. But yeah, Argentina would be a disappointment, but it's more just a disappointment in humanity that we keep having to go. And I guess the maybe one important takeaway for you, and you get it, Bilal, from your questions, is that if you're confused or want to know what's happening on planet Earth, economically and financially, the big variables, talk to an EM bond person. Doesn't have to be me, right? There are others. But that will help you understand that the right way to look at it is there are some over-indebted developed market countries. Japan is one of them. France is obviously one of them. The U.S. is one of them. And then there are a bunch of others that have the exact opposite characteristics, and those are winners. That's the right framing, because what most markets are focused on is euro, dollar, euro, and dollar yen. And that is that is, not the right, that is not going to be information rich.
So I'm glad you brought that up, because I think it brings us to a part of the conversation where it gives you an opportunity as a portfolio manager to explain the value proposition and insight from corporate and government debt at the EM level. And let that be as broad as you want to articulate this point, because you're going to be able to explain growth opportunities, I believe, insight, to your point, as well as risks to be concerned around, obviously, too much debt or not enough growth in said market. So just explain the difference and how people should consider both corporate and government debt on the EM side. And you can use a country if you want to be specific, just to give an example. Yeah,
so I would say the right way to do emerging market bonds is along the lines that you're asking, Bilal. And number one, I think it is to include all types of emerging market bonds.
Okay.
So EM bonds for 20 plus years have outperformed treasuries in the ag on an outright or volatility adjusted basis, right? If you include sovereign bonds, so local sovereign bonds and dollar sovereign bonds. But institutional investors and investors haven't always had good experiences investing in EM bonds. Why is that? Often the decision is made, I like EM. Why? Because they have low debt and the yields are higher, whether it's in dollars or local. Okay. And then the conclusion is, and I'm going to do it all only through local currency. Why? The yield is higher and I really like it. Or only through dollar. Why? Well, some reasons. And that decision, we think that institutions are increasingly looking to blend funds in which they can say, yes, we get it. Everything you and I just talked about, we get it. And we've come to the same conclusion. You can see it in the newspapers, right? Yeah. People are moving, the asset allocators are going to move in this direction. But we don't want to bet it all via one particular vehicle. For example, when the seeder for our mutual fund now ETF came to us, they wanted to be local currency only. We told them, no, you don't want that. You want a fund that's flexible. And they were obviously happy with our advice, because local currency hasn't done well for most of the life of this fund. Now, we like it a lot right now, and it's important to know which local currency. We had a lot of exposure to Asia, which did really well in the last 6 years without really blinking. And so it really gets into the bottom-down corporates. But number one, I think the right answer to your question is, it's very attractive and logical to capture all of the alpha in EM, because through a blend fund where the manager decides how much local, how much dollar sovereign, and how much corporate. And I'd say that's probably the most important point. I'll give you another example. A lot of Asian institutions bought the case for EM bonds. And what did they do? They over-determined it. They said, okay, we're going to do it, but it's going to be only Asia. Which worked out for their sovereign allocations, but you were asking specifically about corporates. They were up to their necks in Chinese corporate bonds at 100 cents, called rated investment grade. That space never showed value to us. And so that'll be kind of the last way of answering your question. I'll tell you about our process. And China's a really good example. As you asked for an example. we were minding our own business, not hurting anyone, and had nothing in China, certainly not in corporates, and because they didn't even show up in step one of our process, which tells us what's cheap.
Yeah.
It wasn't cheap. We want to get paid. That's
Absolutely.
number one. Then the property crisis happened, and a whole bunch of things came up as cheap. Now we have a second step in our process, which is the world doesn't work that way. There are elections, there are policy risks, right, that are non-systematic risks. We have 3 categories for them. And so we began a checklist of, all right, these are the things, we get that it's cheap,
Yep.
but we need to see that the government has told the banks to extend lending. We had a big checklist, and we'd write about it to our investors every month. And we built some very diversified but small exposure to Chinese corporates. They rallied and were pretty much out.
Yeah.
So, the point of the story, I hope, is number one, our process is bottom up, right? It's company by company, country by country. We don't say we don't like all of local or we don't like all of China. Yeah. Very bottom up.
Yeah.
Very bottom up. We don't say we like corporates or we like local, or we'll say the result is that. And China's a good example.
Yeah. No, look, I think you just actually articulated the objective component of investing, right? And your thesis and strategy, right? So it's completely unbiased in that sense. So that's important. But now I want to talk about risk, right? Because the risk factors in emerging market debt seem, and you alluded to some of this, they can be systemic, they can be outside factor based, right? They can be very nuanced in many cases as well. Can you talk a little bit about that? Because to your point, look, tariffs to start the year, everyone would have said it's terrible time to look at emerging market debt and just emerging markets in general. And they've done exceptionally well. So talk a little bit about your thesis, your process, and how you guys look at risk.
Sure. Great question. So first, on the risk inherent in EM, I think that is the reason why I'm so excited about EM bonds, is that's more or less a myth at this stage. That is not when we launched our ETF in Australia, that was the way we presented it to institutional investors, was dispelling the myths. You think of EM as this, and it's actually this. And we can show it either in performance of the asset price, or we can show it in terms of the economic developments. For the last several years, EM local currency bonds have had lower volatility than developed market bonds.
Okay.
So just outright vol, forget that their carry is often higher.
Yeah.
And their correlations with G10 rates have broken down. When you ask someone on fixed income, what do you think of duration? 99% of the people in the world will give you an answer, and they'll give you an answer based on their view on dollar duration.
Yeah.
But duration in Mexican peso bonds is different. Their currency's strengthening, so inflation expectations going lower, their interest rates should go down, which is exactly what happened this year. Their 30-year rallied 100 basis points long before ours does. It wasn't looking at that because it's a different duration.
Great point.
And so that's another example of the diversification you get in EM. I'll say 2 last things. The biggest thing on earth that's happening is what we talked about earlier, which is CNY is rock solid. That's who my countries trade with, right? As Brazil trades with China, Chile trades with China, Malaysia, Thailand, they trade with China. So if that currency is strengthening, that's a massive tailwind to all those currencies. Those are the real winners. Right now we have very low exposure to China itself. We think the currency is going to be stronger than anyone expects, but it's going to be watching paint dry. That's the anchor. The rest of these countries are winners. The last thing I'll say, we have it coming in our latest monthly, but it's very hard to find in any of my countries political parties or institutions that think you're supposed to harness the central bank for economic objectives.
Okay.
You just don't find that kind of stuff because, and we've written about this, they saw what that results in the 90s. Now, maybe it results in that because they didn't have the right conditions, but it doesn't matter why.
Yeah.
But in Mexico, You destroyed the banks, you destroyed the poor, you destroyed people's savings, political parties and careers were destroyed. So this anti-inflationary focus and this low indebtedness and fiscal orthodoxy culture is really profound. And it characterizes South Africa, it characterizes Thailand, it characterizes Indonesia, at least in their statements. We're not so sure whether they're going to implement it. Now, not every country, but it's really profound. And if you look at the popularity of these leaderships, they're all north of 60%. And look at in the developed markets, right? You're lucky to get in UK below 20. President Scheinbaum of Mexico is like near 80% approval and is incredibly orthodox in her economic management, as as her predecessor was.
This is a really interesting question, because you bring up so many different dynamics, and it's almost like a fragmented table, right? The
mosaic.
Mosaic.
I like to think of it as a mosaic.
It's a very unique mosaic of countries, policies, possible risk, but at the same time, massive development opportunities. How does your team stay on top of this global landscape, given time differences, given geopolitical changes, just at the speed and the rate of change?
Yeah, great. That's a great question. First, we all grew up in sell-side research. Okay. And that is just it's the hardest, most thankless job on Wall Street, but you're pretty much beaten up every day by people who know something almost as well as you do, and your job is to finally know it better than anyone you're going to get questioned from. And so it just conditions you differently. And so we each grew up waking up in the morning, like for me, for example, I wake up in the morning, where's the ruble going to be? Where's the South African rand going to be? Where are credit spreads going to be? What are the developments, all this kind of thing, but on very specific countries. What does it mean for the 3-year bond? What does it mean for the 10-year bond? And so we designed a process to allow us to do that. How do we do it? We have step 1, which is our favorite step. What's cheap? That's the boss. Yeah. That is the boss. Tell me what's cheap and give me the order.
Yep.
So I know what to focus on. Because once we see that, I've been doing the other job for 30 years, right? Well, we might fail or succeed, but it's the whole point is to have a good answer to your question, Bilal, which is we're focusing on specific things. Like the China example, don't need to be experts on the property sectors. So what if we are? Or there's no money to make. The only money to be lost was what step 1 was telling us. So that's how we do. We got a great team, and we talk 24/7. Okay. And we text and we share pretty much every single thing, because something in Malaysia could affect something in Brazil, and or you might meet someone who knows a lot about Brazil in Malaysia. That happens, and so constant communication as well.
I love that. So I want you to sort of bring it home and give a great example of, and not even an example, just your thought process on what's the best opportunity, in your opinion, to get exposure to emerging market debt, 1, and then 2, simplify why people should consider the asset class going forward and make the case for emerging market debt.
I would say the best opportunity is a blend EM bond fund with experienced managers that diversify their exposure to EM countries, because it's EM that is the place with low debt and independent central banks. I'll give you a precise metaphor for an advisor in the U.S. Put yourself in Portugal during one of the Eurozone crises. You're in Portugal. You got a bunch of $1 million accounts. What are your regulators and your customers telling you to do? Own Portuguese government bonds, right? The capital charge is low. It's collateral. It's this, it's that, right? It can't go wrong.
Yep.
Portugal was downgraded to lower than Nigeria's rating during the Eurozone crisis. Now, those advisors all survived that first crisis because they were all saying the same thing. But first of all, I don't think that's the culture in the U.S. compared to the European advisor culture. But also there was a second round. After a while, the dust settled and folks said, well, I should have owned bonds, or I should have owned gold, or I should have owned stocks, or I should. And so I keep that in mind. As this stuff happens, it's normal. It happens to highly rated countries. How should investors consider the asset class? Well, I'll say a couple things. First, maybe they take away, wow, I shouldn't be up to my neck in treasuries and bills and think that it's safe. That's a reasonable takeaway.
Fair.
But I think that the right way to look at it is there's a big message in gold. Huge message in gold. An economic historian is not going to say about 2025, oh, the dollar lost 15% against euro. That is not going to be the headline for a historian. The historian is going to be the dollar lost 50% against gold, and then there's a whole bunch of other stuff going on with currencies.
Yeah.
And so, and why is it? Central banks are buying. We all know that. And they didn't send a press release. What else are they buying? They're buying local currency bonds, and they're not going to send a press release on that. That's what's happening. When you saw those headlines in earlier years about UAE, Russia, Brazil, China, Saudi Arabia agreeing to trade in each other's currencies, which had previously been priced in dollars, what do you think these central banks are going to do with a pile of rial or rupee? They're going to open bond lines, right? And they're not going to send a press release for it. So there's actual central bank demand for these. That's our surmisation. And it's similar to what's happening with gold. Central banks want reserve assets in low indebted countries with independent central banks. And the U.S. is, especially because of sanctions, is less obvious than it used to be as that. And there's a search for alternatives. Gold was the first, but this is happening as well.
Wow. This has been fantastic, Eric. I really appreciate you taking the time.
I loved your questions, Bilal. Thank you.